talk more about markets and, of course, what's the way ahead. Let's quickly get on to our next guest of the show. We have Harshal Dasani, who is the business head of INVasset PMS, joining us. Harshal, good afternoon. So good to have you with us. And, resuming this conversation once again after a long time, let's first address with what has happened on the ATF price hike news. First, we did see Indian oil hiking prices up to 115%, and then later they said that it was applicable only to chartered planes. And then again we had Ministry of Petroleum coming out and saying no, the hike is just capped about 25% for the domestic routes. So flip-flop situation. How are you reading this entire episode that has panned out today?
Good afternoon, Lavisha. Thank you so much for having me again. So the aeroturbine fuel price, as we were talking about. So yes, the news came out yesterday that there's a hike by 115%. But if you read between the lines, it's not 115% for the domestic airlines. It is just for the chartered flights and the international flights out there. So what do you see for the domestic flights? I think the rate has been hiked by just 8.5% from 96,000 rupees to I think around 1,04,000 rupees. So if you look at that hike, technically it's just around 8.5%. And this is also not applicable. The 114 percentage is applicable to all the international flights. So I think that it was the misinterpretation of the news. But the minister has also mentioned that the hikes can go up to 25%, but they'll be much more in a staggered manner and they'll not be all at once. You see, the major problem with ATF comes is that ATF does not come under GST. It comes under the central excise, which is 11%, and then there is hikes anywhere between 0 to 29% on state VAT. So I think because of that, the any little hike in the price of ATFs puts pressure on the airline companies. So I think it was just a confusion, and I think it has been cleared out by the minister and also IOC.
That's right. That's right. But how are you seeing this pressure going ahead in terms of the airline companies? Do you see some bit of a profitability pressure given that Brent crude still remains above that $100 per barrel?
Till the time I think Brent crude is above $100 per barrel, airline companies are going to face the heat because if you see 40% of any airline cost is their fuel. And any increase in the price of that is going to significantly impact their margins. For example, if you look at Indigo, okay, Indigo, I think Q1 FY27, I think we're going to take a 400 to 600 basis point hit because of the current spike in the price of crude. So I think, yes, the companies like maybe SpiceJet, who are running on very thin margins, they'll have a big hit on their cash flows. So overall, I think Indigo will be able to manage the situation much better than all of these. But again, if you look at them, they are going to face significant pressure on their operating margin. So the second point, which I think is again creating another set of pressure, is not only the hike in the price of the aero turbine fuel, but also the USD INR. See, if you look at USD INR right now, USD INR is trading somewhere close to around, I think, 95. So the aero turbine fuel is measured in dollars. And because of the spike in the USD INR, they're already facing the heat. On top of that, because of the West Asia conflict, you see, all the routes over Iran, any flight that would want to go to Europe over Iran could not fly because they're all no flying zones because, of course, there's a war over out there. So they will have to take alternative routes which are longer. And I feel that is going to create another pressure because more use of ATF plus expensive ATF plus USD INR at 95. So airline companies are going through, I think, a major tough time. But I think till the war is there, till crude is above $90, they're going to face a lot of heat.
That's right. That's right. But despite these measures, we have seen that Indigo has appointed a new CEO. That's your William Walsh. It's a heavy lifting for this, for the new CEO to do from August 3rd onwards. But how significant is this from a strategic standpoint? And of course, given the stock has corrected by about 20% in the last 1 year, what do you think the way ahead for this particular counter is?
I think the current CEO that is appointed has a great history back then. He has been part of mergers. He has also been the Director General of the International Airline Group. And I think no, he was the CEO of the International Airline Group. I'm sorry. He's been the Director General of the IATA. And he is also, if you look at Indigo right now, Indigo is 64, I think 64 to 65%, their entire market share is domestic. And their planning to expand into international, this is the exact person they kind of need right now, because we heard that in the late December 2025, the CEO had exited and the current promoter was acting as the interim chairman. Indigo currently is facing through a tough time, and on top of that, the current war. I think the stock also has reacted very greatly to the appointment news of the new CEO. And I think Indigo needed this for a little more stability and a little more expansion. Currently, they're facing a tough time because of the war and the increase in the price of their overheads. But I think over time, it should fit in well.
Okay, it should fit in well. All right, let's talk more about markets and shift the conversation right now, Harshal. We are seeing recovery after 2 days, and this is coming after US President Trump has signaled that he wants to end the war by the next 2 to 3 weeks. Now, given the kind of conflicting statements we've heard from him from the past few weeks so far, and India which still remains at elevated levels, how are you reading the situation at the present, and how would you suggest investors to brace themselves in the upcoming times?
Well, honestly, as I mentioned, till crude is above $90, I don't think that the markets are going to stabilize anytime soon. Though you will see a small bounce backs coming on the news announcement that we are in advanced talks with Iran. We're going to do that. But I think since the last 30 days of the war that we have seen, we see those tweets almost every day. There are short-term bounce backs. But there's no long-term solution to this war, because if you look at both of the parties, if you look at US and Iran, both of them desperately want to stop the war. If you look at US is desperate for oil right now because Strait of Hormuz is closed, and almost a major chunk of the world's global natural gas and oil supply is through the Strait of Hormuz. So US desperately wants to end the war. Also, the major problem that US is facing right now is their anti-missile defense systems. The missiles in the defense systems are running low on number. So that is why you see that Iran is hitting Israel, Iran is hitting Middle East countries, and US is not really able to protect them. And if you look at on the Iran side, Iran also wants to end the war because they are doing carpet bombing of Iran right now. And Iran does not really have a lot of missile launchers left with them to launch another missiles. And they would also want to stop this war. But the conditions, if you look, both of them have. None of them are ready to accept each other's condition. US wants Iran to stop enriching uranium and give all of the uranium stockpile that they have back. That is not what Iran really wants to do. Iran really wants to go back with it. And Iran also wants the compensation of the war damages, which I don't see US paying down the line. So I think the situation is a tussle, and they both need to come out to a solution which is on the middle ground. Until that is happening, you're going to see all bounces in the market are going to be short term, because if crude is above 100, I think 100, it's nearing somewhere around 100, $105. I think it has just slipped below $100 today. And with that, the inflation in the world is going to spike up. Everybody is already facing with an inflation problem. So I think crude needs to be managed below $100. Once it's down below $100, I think market should stabilize and move up again.
Okay. But yes, crude is once again above that $100 to $103 per barrel.
Correct.
Harshal, at this point of time, what does this mean for India's inflation and growth risks going ahead? Because we've seen earlier arguments that, if oil stays above $100 per barrel, it's going to aid into 25 basis to 30 basis points into our India's inflation rate. What's
Correct.
your take? And of course, it's been over a month since oil has been above that $100 per barrel. So if indeed it stays for another month, what does it mean for India in terms of macro risks?
Well, I think if oil stays above $100 for another couple of months from here, it is really going to create problems for India, because we are purchasing oil above $100 plus. If you look at USD INR is at 95. So our forex reserves are almost vanishing in buying this oil. So I think that if another couple of months this war pulls up, it's going to start creating problems for India, because we have a buffer for 2 months. Though we are negotiating our supplies with Russia, but again, it's not going to be that easy because it takes time. And even if you look at this, a lot of supply chain disruptions have happened, and oil is the basic raw material for any and every product that you have. For example, even the food that we eat. Okay, for example, there's a shortage of gas right now, and you see majority of the restaurants have start using items that consume a lot of gas. And on top of that, even if you look at fruits and vegetables, the basic raw material, they all get transported, and the basic raw material comes down to oil. So I think we are going to see a spike in inflation. And if that kicks in, then I think the rate cuts that we are having is going to slow down for some time. We've already seen US Fed holding up the rate cuts. So I think it's going to be a tough time if this war continues. And even if you look at the growth projections for EPS of Nifty, the EPS of Nifty was expected to grow between 14 to 17% for this year because the FY26 base was very low. It grew just by 3%. So we were expecting around 14 to 17% growth. If a couple of months oil stays above $100, the growth can be severely impacted between 8 to 10%. And if this war sails through September and the crude prices manage to stay above $100 till September, then you might see the growth falling down to even single digits, 4 or 5. So I think anything above $100 for any country is going to put a significant pressure on their inflation and is going to slow down the growth. So the war needs to stop, is all I'll say.
Okay, okay. So in this scenario, are you revisiting your earnings estimates for FY27? And by how much, if that quantum you can specify?
Well, I just mentioned the earnings estimate. I was talking about 14 to 17% were the earnings EPS estimated for Nifty because the last year's base was very low because we had just grown by around 3%. So I think that, yes, if the war continues for a couple of months, we're already going into single digits around 8 to 9%. And if the war sails through September, we're going to see a severe shock in terms of the growth in EPS of Nifty. So yes, anything above $100 is not good. Oil needs to stabilize below $90 for the markets to form a base and stabilize.
Okay, okay. But do you think that the worst of the conflict in terms of oil price rises and, of course, the rupee depreciation is already baked into the equity price?
Well, yes, I think equities do react very quicker to the situations. So I think that, yes, a major part of the fall has already been discounted. But also, what I think is that the another few days are not going to be a V-shaped recovery in the market. All you will see is the markets slowly and staggeringly, they're just bouncing up a little, then they'll again get sold off. They're bouncing up a little, then they'll get again sold off a little. They'll enter into a short-term consolidation phase. You'll not see a steep fall from here that markets are wiping off another 20-25% from here. I think we've already had a big dip. The small cap index is down around 20% from its all-time high. Plus another 2 years of time correction, we have hardly done anything. So I think that the markets are not going to have a steep fall from here. They're going to be into another maximum 5 to 10% correction from here. But what I think is that they're going to spend a lot of time here. They're going to spend a couple of months here. Also, even if the war stops, the supply chains that have been disrupted, the insurance prices that have been spiked up, they'll take some time to settle down. So another 3 to 6 months, I don't see a very V-shaped recovery until the war really stops very anytime soon. But I don't see that as happening as we see Trump has started moving on ground troops towards Iran. And you have to look how the war shapes ahead.
Okay, okay, got it. So at this point of time, do you think that investors should buy the dip? And if they should, is there any opportunities that you're spotting?
Well, I think that this is an amazing dip to buy because this is going to be one of the last dips that we get before the next leg of bull run. Because if you split India domestically and globally, we're doing really great. Domestically, we have had 1.25 percentage of rate cut last year. We have had GST cuts, we have had tax cuts, and the consumption is picking up. If you look at India globally, India is doing globally fine. We have done deals with UK, we have done deals with New Zealand. India and US trade deal is on the verge of talks. We are seeing some progress, but because of the Iran-Israel war, I think the talks have currently halted. But we are doing fine with China. We're doing fine globally. Our global resource is also doing great, but the current dip has caused some issue. But I think overall we are doing fine. We have not even participated in the bull run last year. If you look at global markets, if you look at Japan, if you look at Korea, if you look at Taiwan, even if you look at US markets, Dow Jones and Nasdaq, they've been doing really fine for the last year. But India has not been really performing. So I think we've had a gap in terms of performance. We have had a time correction. And Nifty's PE also, if you look, it's trading around 20 from its peak of 25. So the valuations are also a comfort. I think that this is one of the last dips that you're getting before the next leg of rally. You're not going to get such a good dip. And this good dip is because of an external factor and the crude price rising. The crude price is not rising because of the demand increase. It's rising because of the supply shortage. And it's not going to last a little more longer than the war ends. So I think, yes, this is one of the last dips. And you should start buying. See, you never know where the end is. And the markets are not going to slip more than another 10% from here. So every small dip should be a good chance to accumulate.
Hmm. Okay, got it. Any opportunities then, since you are finding this dip, quite attractive at the current levels?
Absolutely. Well, I cannot go stock specific, but if I talk about sectors, metals as a basket looks very good to me. The metal prices are currently correcting because of the global growth slowdown because of the current war. But I think once the war settles down, I think you should see a big bounce in the price of metals, specifically copper and aluminium. So I think all those PSUs that are into metals are doing really well. Even the private players are doing a great job. And I think banks, financial institutions would do really well. In banks, I do not really prefer the large caps. My preference and my choice would go towards the PSUs and the small cap private banks that are out there. Any small cap private bank between 5 to 30,000 crore market cap, they would really do good. And PSUs are offering a great value, even if you compare them to the private banks. PSUs offer a great value. So I think PSU banks, private small banks, and metals are those sectors that I'm really looking forward to.
Okay, okay, got it, got it. What about, all of these defense stocks? Today we had Garden Reach coming out saying that they are seeing one of the highest revenue turnover in FY26. But in the last month, we have seen this is one of the sector which has poorly performed in terms of, stock performance and, of course, index performance. Where do you lie there?
Well, defense is really good. During the times of war, defense generally sees an inflow. But I think that the 2022 rally in the PSU, defense, railways have taken them to a rooftop valuations. And the fundamentals are picking up, the top line and the bottom line is picking up. It is not that they're not picking up, but the valuations that they're sitting at and the prices that they are sitting at are way ahead of their fundamentals. So I think that any major news like war is going to trigger a short-term buying into them, but they again go into that consolidation phase. Even if you look at GRSE, Mazda Dogs, Cochin Shipyard, HAL, all of them have been into a great consolidation phase. They see buying. We saw buying during Operation Sindoor also, but it all eventually got sold out. Even during this war, we are seeing a buying, but they'll all eventually get sold off because the prices are way ahead of their top line and bottom line. So I think defense is good. It's into a long-term consolidation. It has seen a major price move in 2022. It would take some time to settle down. And once the fundamentals pick up with the price, then you would see defense roaring up. Yeah, during wars, defense generally does well.
Hmm. It does well, but then, this time we have seen that defense sector has been one of the worst performing sectors despite the war volatility. I mean,
Exactly,
Harshal,
because they are sitting at a very peak valuations. If you look at the valuations right now,
hmm.
also, they're sitting at a very peak prices, and the fundamentals have not really caught up. So I think the war is keeping up defense. If you look at railways right now, railways have gone into a steep correction. They are not really performing. War is the only trigger that has kept up defense for all this while.
Okay, okay, got it, got it. So at these valuations, do you think that investors should stay away from all of these narrative stocks, be it defense or railways?
Well, I think that this market, the bull run that we are going to see after the correction that is happening right now, the third leg of the rally, is not going to be like the COVID rally or is not going to be like your post-Russia-Ukraine war rally, where anything and everything is running on the basis of narratives. Here, very
Hmm.
strong books, very strong growth in top line and bottom line, very strong managements are going to lead. So I think defense and railways are amazing. They're excellent, but they have ran ahead of their time. And second, their fundamentals are not picking up. For example, if you talk about RVNL today, okay, RVNL's top line in 2022 was 20,000 crores, and RVNL's top line today is around 23,000 crores, if I'm not wrong. And the stock price has gone from 40 rupees to a high of 600 rupees. So if you look at the price, it has gone 15 times. But if you look at the top line, it's not even close to 15% growth. And there's not even any great growth in bottom line. So even if you look at railways and defense, these companies, they get big order books, but it takes time to execute and it takes time to show that in their books. So I think until the fundamentals, top line, bottom lines are not picking up with the prices, they're going to go into steep corrections. You look at RBNL today, RBNL is trading below 300 rupees, where it was at a peak of 600 rupees. I was just looking at a stock called TexRail, which went from 80 rupees to 300 rupees and it's back to 80 rupees right now. So it's a 75% dip in the stocks. So anything and everything that is not performing, that is just running on narratives, is going to enter into a steep mode of correction and is not going to participate in the rally ahead.
Hmm. Okay, okay, got it, got it. Harshal, how are you placed on the IT companies? We've seen significant correction, But since the war has escalated, this is one of the sector which has remained fairly resilient, if not in a complete meltdown mode. Where do you stand here?
Well,
And of course, what do you expect from the fourth quarter results?
It has been standing fairly resilient, but it is because it has already corrected more than 25% even before the war started. So if
Yeah,
you look
of
at the
course.
Nifty IT index as a overall index, it is already down 20% before even the war started. And after the war, it took another hit. See, the problem with Indian IT is AI. It's very simple. It's just one word, AI. If you look globally right now, Kospi, it's just running. South Korea's index Kospi, it's just running on the basis of Samsung and Hynix. If you look at TSM Taiwan, it's just running on the basis of TSMC, that is the semiconductor. So if you look right now, the entire world, there are two sectors that are pulling up the global markets. That is AI and semiconductors. India does not have semiconductors, but India had IT. And we had a good chance to give a pivotal shift towards IT. You see, everywhere across the world, we have our people who are the CEOs of these IT companies and leading the companies outside. You see, our companies, they have reserves with them to put into research. What are we doing? We are doing buybacks and we are not doing anything towards AI. Till we don't take a pivotal shift towards AI, these companies are going to see a major sell-off. What do you expect from a company who's sitting at a market cap of 5 lakh crores and giving a revenue guidance growth of 3% every year? They're not going to give you any great performance in terms of stocks because they're already sitting at an elevated valuations, right? So what I personally believe is until IT companies don't take a pivot towards AI, they're going to be sold on every rise that they have. And technically, if you think USD INR is at 95, which is very beneficial for these IT companies who have their businesses outside because when they earn in dollar and when they get back to India, they are converting, they're having a great foreign exchange rate. But even after the great conversions, you see the IT companies are struggling. They are like down 35%. Companies like TCS and Infosys are down 35% from their all-time high. So if you remove Nifty IT technically from Nifty, Nifty would have made a new high by now. So Nifty IT, I personally think that it's going to be a sell-on rise. Well, I don't think that TCS and Infosys are going to fall more 20-25% from here, but I don't think that they're going to give you a steep rise and are going to double up your money in the next couple of years. They're going to enter into a consolidation slow phase until they see any major pivots towards AI. And we need to do that quick because there's a lot of competition. You see, right now, Anthropic's Claude, it has taken over majority of the work. A website that took around 10 days to get coded is getting coded in a couple of hours. So we need to move fast with AI. That is where IT needs to play that role.
Okay, okay, got it. So at a time when, we have Nifty IT still, lagging into returns, and of course you're pointing out that, given that the AI related volatility is there, we might be in for a low single digit, growth phase for some time. So at a time when we
Correct.
are, when we are expecting some kind, very low growth from the IT index, and it carries a heavy, weightage in the Nifty 50 as well, about 9 to 13% itself. So are we
Correct.
going to, do we as investors need to reset our expectations in terms of large caps performance and of course an overall index performance going ahead?
Well, yes, because IT is one of the major components of the large cap indexes and any mutual fund that you buy for large caps. So, for example, even if you open TCS and Infosys shareholding patterns, you'll see FIIs have been dumping constantly and they're all accumulated by DIIs. Now, technically, DIIs may sound as institution, but they are technically retail investors' money. So, yes, I think the large caps are going to struggle for some time if you look at index as a whole, because index has a major chunk of IT. And I think other stocks also, like for example, auto and your OMCs and paint companies, they're going to struggle for some time because if you look at Nifty, only banks look attractive to me in Nifty and to some extent Reliance. Any other companies that you see in Nifty, any paint companies, they're all going to face pressure because of the rise in the crude price. And overall, the large cap expectations is going to be a little laggard for some time because you look at large caps have not technically performed. If you look at any major banks or if you look at Reliance, they've hardly given any returns in the last 3 or 4 years. And on top of that, the current war has created an additional dip in them. Well, they look very attractive in terms of value basis, but I don't think that there's too much growth left to them. So I think, yes, there is some cut in the expectations towards large cap, though they are available at a great price, but uh, I don't think that they'll be able to perform that great as in comparison to small caps and mid caps.
Hmm. Okay, okay, got it, Harshal. All right, it's a wonderful conversation, but with that, we have to let you go. Thank you so much for your time and joining
Thank you
us.
so much. Thank you so much, Lavish. It was great talking to you. Thank you.